On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Okay, team, let's look back on last week, and it was a pretty good one for most share markets. Europe was up 1.6%. The UK market, the FTSE 100, surged 3.1%. That's the best weekly performance since early January. It was up a little more than that in the very first week of this year. But since then, it hasn't had a week as strong as that. So the UK, very strong. The Aussie market also strong, up 1.8%. The S&P 500 in the US, though, it bucked the trend. It actually fell ever so slightly, not by a lot, just 0.2%, but still the second consecutive down week that the US market has suffered. The local market was pretty flat. We were up very, very marginally, but you may as well say it was a sideways week for us. It was a really interesting one, actually. We'll talk about a couple of these things, but long story short, you had some more strong economic data out of the US, very strong retail sales. That's, I think, partly due to consumers who still have excess savings from the pandemic. That won't last forever. By most estimates, around the end of this year, we will have seen those excess savings run down, so things might change. But strong retail sales, also a CPI report, a consumer price index inflation report, and a PPI report, the producer price index, both of those on the high side. So in the US, you've still got a very resilient economy, things still very buoyant, and inflation pressures have slowed a lot, but they're still there. Then Europe, very different kettle of fish. Looking a little downbeat in Europe, and they're sort of almost heading for that stagflationary outcome where growth is not nearly as strong as they would like, but inflation is uncomfortably high, which means the central bank is in a very difficult position where they need to keep interest rates up at quite high levels, even though the growth isn't there. So Europe, not looking fantastic when you sort of think about how the next 6 or 12 months could play out. And what else do we have? China, obviously they have had a rough ride, but there was some figures out of China that did point to a bit of stability. And then you got Japan, which is on the cusp of actually winding back that yield curve control monetary policy much sooner than people might have thought. So yeah, geez, there's a lot going on. Interest rates last week, the US 2-year Treasury yield increased slightly, increased from 4.99 to 5.03. The 10-year was up about 7 basis points, finished at 4.33. In New Zealand, it was a similar story, up, but not by much. Our 5-year swap rate rose from 4.89 to 4.92. So look, there's not a huge amount of difference between all of those numbers, is there? Oil kept pushing higher. WTI crude up another 3.7%, so sitting just below $91. That's the highest since November 2022. About 36% above the lows of this year, which came in March, so about 6 months ago. But still well below the peak that we saw in 2022. You know, it was sort of 123 odd dollars. So oil has pushed higher, and you're starting to see that in some of the inflation figures that have come out recently. I'll try and whiz through it all because, geez, there were a lot of releases. US inflation was the big one. This was for August, and as expected, stronger at the headline level. The headline CPI up 0.6% for the month. The previous month it was 0.2, so that's the biggest monthly rise in more than a year. And we saw the annual inflation rate push higher as well. It pushed up to 3.7%, which obviously is still well below where it got to last year. Last year it was as high as 9.1, but that 3.7 that we saw for August is higher than what we saw in June and July. In June it had come all the way down to 3, then in July it picked up to 3.2, now it's up to 3.7. So not really what we want to see. I don't think it really changes the outlook dramatically. It just reminds us that the easy gains have been made in terms of getting inflation down. From here, it gets a little bit trickier. The better news was that the core continued to fall. It was actually up marginally for the month compared to the previous couple of months, but not by much. And at an annual level, rose 4.3%, which is down from 4.7 in July and the lowest in almost 2 years. Obviously, doesn't include food and energy, and higher oil prices, higher fuel prices, feed into that energy category, which is why the headline sort of rebounded as much as it did. On the central banking front, we had the ECB in Europe hike interest rates, and this was sort of a line ball call. So they might have hiked, they might not have in the eyes of markets. Markets were divided. In the end they did hike another 25 basis points. That takes their policy rate to 4%, which is the highest that it's been since the euro was introduced in 1999, and since that monetary union came into being. So I think in 2001, their policy rate got to 3.75. They've obviously pushed above that now. So that was the 10th consecutive increase. It was interesting. You read their statement, you listen to the press conference, definitely an air of hesitation about the hike. I think they know that the economy actually isn't strong enough to handle much more. So it's probably a reluctant hike. They're definitely aware that things are quite fragile, but they've also got this inflation issue that they need to deal with. So really interesting reaction from financial markets. Markets aren't pricing in any more hikes from here. Well, not to any great degree at least. So in the eyes of markets, they see this as the top, and that was sort of what the ECB hinted at. And looking forward, markets actually brought forward the timing for the first ECB rate cut. So it was sort of July-ish, and they've brought that forward slightly to June. Things could change, might not play out that way, but what it does tell you is the market interpreted this hike as being something that might sort of just be a little bit too much for the economy to handle, and it could cause things to slow more sharply than hoped and expected, and they basically see the ECB in a position where it will be cutting earlier. So that was really interesting. Like I said, we had some Chinese data came out on Friday afternoon, better than expected. So I don't think it tells us China's out of the woods, but hopefully it does point to a stabilization in the economy. Industrial production, retail sales, both rose at the fastest pace we'd seen since April and May. And I think the raft of measures we've seen to support the property sector and sort of the flagging economy, they do appear to be working. We've seen an improvement in bank lending. We've seen an easing of deflationary pressures, and vehicle sales are up. So good to see some signs of stability out of China. On the local front, we had the housing market report, and as expected, house prices are enjoying a rebound. So we saw sales volumes up. We saw the number of days to sell down, and we saw the house price index rise again. So for the last 3 months, we've seen house prices nationally rise. They're up about 2.5% over that period in total. And that obviously comes on the back of a 18% fall between November 2021 and May of this year. So good to see. Look, we've still got an affordability issue, so we don't want to see house prices take off too much, but stability is good. Positive for confidence, positive for the way people feel, and I think net, that's a good thing from an economic perspective. Looking ahead, you've got the election, and I think if that goes the way the polls are suggesting, the housing market will be in a better spot too, because National's policies are definitely more friendly to the housing market. So that does bode well, I think, for the period ahead. We had the PREFU, the pre-election economic and fiscal update last week, and it was pretty much in line with expectations. In a way, actually not as bad as expectations. So we saw revenue lower across the board. The tax take is down, expenses were up. That's partly due to weather events. The surplus pushed out a year, and estimates for net debt have risen as well. The economic forecasts were interesting. They were actually a little more upbeat than some might have expected. Growth revised down for this year, but up in 2024. I think part of that will be strong migration, which is another big story we're seeing at the moment. Migration is much stronger than anyone has expected, and that's definitely a real positive from an economic standpoint. No forecast of a recession in those prefu forecasts from the Treasury, so that was interesting. They do have unemployment rising, but not quite as sharply as before. So that's all good to see, I guess. What's important to note is that these figures only account for what is actually already in place in terms of government policy. So what they don't include are any proposed government policies. So they will change. As soon as you put the election behind you, whether it's a new government or a different version of the status quo. The former obviously looks much more likely at the moment. You'll see these change because some of the proposed policies will become a reality. So that's what we had last week. And looking ahead this week, it will be super busy. It's another incredibly busy one. We've 3 central bank meetings, 3 big decisions due: the Federal Reserve in the US, the Bank of England in England, and the Bank of Japan in obviously Japan. So the Fed will be the main event. Their outcome will be announced at 6 a.m. on Thursday morning. Then you get a press conference to follow. You'll also get a new set of economic projections, a new SEP. The last lot came back in mid-June, so that'll be interesting because a few months have passed. Nobody is expecting a hike from the Fed, so they're expected to just sit tight at 5.5%, which is the same as our OCR. For them, that's the highest since 2001. Hard to know whether we'll see any more action from the Fed. I'm in the probably not camp, but markets are pricing in one more hike to the tune of about 50%. So markets are sort of divided as well. I think at this meeting, what will be of most interest will be, the commentary and how the new forecasts look. So, it's sort of appears to be a foregone conclusion that they won't actually make any adjustments to monetary policy. So it'll be all about the guidance for the future. So that's on Thursday morning. On Thursday night, the Bank of England meets, and they are expected to hike their policy rate, just like the ECB did last year. That part of the world is grappling with higher inflation than it would like, and that's why they're having to take more action than some others are. So that would see the B of E policy rate at 5.5%. It would be the 15th increase in a row. And that would mean interest rates are at the highest levels since 2007. Back then, they got to 5.75, so they'd be not far off. And market pricing does point to a reasonable chance of one final interest rate hike, which would see them match that pre-GFC high. Inflation has been coming down in the UK, but not as quickly as hoped. So they've still gotten a headline CPI, annual CPI of 6.8%, which is still obviously very high. And interestingly, they will get some fresh inflation figures out on the Wednesday, so a day before the Bank of England meeting. Markets expect it to rise slightly to 7%. And as we saw in the US, that will be partly due to energy and fuel prices. So the Fed on Thursday morning, the Bank of England on Thursday night. On Friday, rounding out the trifecta, will be the Bank of Japan. And their latest monetary policy decision will be very interesting. There was an interview with the BOJ governor earlier in the month by a Japanese newspaper, and the comments were a bit more hawkish than expected, and that has got people thinking that we might see an end to their yield curve control and their negative interest rate policies than people previously thought. So the negative interest rates would not be changed at this meeting, but you might see them adjust or even drop that yield curve control at this meeting. Maybe not, but that'll be what they'll do first, and that would then be a precursor to abandoning the negative interest rate. So We'll have to wait and see. Japan has seen its inflation rise. They've had very low inflation and sometimes deflation for many, many years, but they've now got, in recent months, we've seen Japanese inflation rise above 4% per annum, which for them is super high. That's the highest since 1981. So uh, we'll just wait and see what plays out there. That has the potential to steal the show. If you get just an as expected, nothing to see here sort of meeting from the Fed, and then the BOE, they just hike rates as expected. It's the BOJ, which could be the one that everyone is focused on. On the economic front, for me, the most interesting things to watch will be the September flash PMIs. These are out late in the week, so I think Friday morning, late morning, we'll get the Aussie flash PMI, then the Japanese PMI follows just after lunch, and then overnight on Friday. So late Friday, early Saturday morning, you get the corresponding measures from the UK, Europe, and the US. And these will cover the month of September. So, as always, they will be one of the first indicators for the new month. So, that will be interesting. Great way to sort of take the pulse of economic activity. The last few months have pointed to slowing activity almost everywhere. China and Japan were the only regions to see an improvement last month. In the case of China, that's because they were coming off a run of very weak indicators, so it's more of a stabilization than sort of growth as such. But Europe, Australia, the UK all saw their PMIs fall into contractionary territory, which means month on month, you've got the economy in all of those places shrinking. The US has been a beacon of strength, obviously, and I think it still will be relative to others, but it still saw its composite PMI. The composite, that means it's a combination of manufacturing and services. You get a manufacturing PMI, you get a services PMI, and then you get a composite PMI, which sort of covers both. So it's kind of, both of them put together. And the US composite PMI did remain in expansionary territory, but only just above break even, but it was still at a 6-month low. So we'll be watching those. We'll be watching the inflation indicators, and we'll be watching the difference in strength between the manufacturing sector and the services sector. In recent months, manufacturing been very weak, services been very strong, but started to see some of that weakness creep into the services sector as well. So that is something we will be keeping an eye on. So that's the rest of the world. Here in NZ, a few bits and pieces to watch. The most notable will be another dairy auction, which will be out early on Wednesday morning. And obviously, at the last auction, we saw a rise, 2.7% at the headline level. That was the first increase in 4 months. So that will have been welcomed by the sector, and we'll be hoping that we see another uplift in prices. Obviously, you've seen Fonterra cut its milk payout twice for the current season, and with prices at 5-year lows, we're looking at a payout that is the lowest in 4 or 5 years as well. And the Chinese slowdown has been a big part of that. So Wednesday morning, that'll be in focus. And then on Thursday, GDP for the June quarter. So this will be interesting because we obviously had 2 consecutive quarters of contraction. The December 2022 quarter, I think from memory, the economy was it shrunk 0.7%, contracted by that degree. And then in the March quarter, we saw a very marginal contraction of just 0.1%, which, for me means that's not officially a recession. I don't think that's the quantum of decline in activity that you need to see to sort of constitute calling it a recession. But anyway, some people would disagree. But because we've seen those 2 quarters in a row of contraction, this one will be in focus. The Reserve Bank, I think, has 0.5% in terms of the increase in GDP for the quarter. The Treasury was a little more upbeat in its pre-food forecasts. It had 0.6%, and the market consensus amongst economists is a little more cautious, 0.4%. So unless something really weird comes out of left field, this will be the best quarter that we've seen since September of last year. So I guess that's good. A rebound after two pretty mediocre ones, but something else to be aware of is it's getting a bit dated now. This is April, May, June sort of figures. We're sitting here on the cusp of almost October, and things have changed quite a bit when you think about what's happened with China, with dairy prices, and the flow-on effects there. So it sort of is old news, and it doesn't tell us a whole lot about the future. But GDP always gets some attention, so I'm sure that will be the case again this week. And politics as well. Politics will be in the spotlight. Less than 4 weeks to go now until the election, and we're in that period where we will see all the debates. So there was the finance minister's debate last week in Queenstown, which I think was live streamed. That's one that they do in conjunction with ASB, I believe. And this week on Tuesday evening, we'll see the first of the TVNZ leaders' debates. So that will be interesting. Expect some fireworks, expect a bit of entertainment, and maybe we'll learn something if we're lucky. So Tuesday night, keep an eye on that one as the election sort of season heats up. In terms of corporate news and announcements, pretty quiet, but there's a few things to watch locally. Mercury NZ hosting an AGM on Tuesday. KMD Brands got a result on Wednesday. That's Kathmandu. Fonterra announcing its result on Thursday. And overseas, what do we got? AutoZone, Ocado, FedEx. That'll be an interesting one. Always watch the FedEx result. It's a bit of a bellwether for how the economy is going. So, you learn a lot. Keeping an eye on the FedEx result. It's on Wednesday. And Darden Restaurants on Thursday. I think that might be the company that owns Olive Garden and all of those other very well-known chains over in the US. So that's how the week is shaping up. A pretty busy one with those three big central banks, with the flash PMIs, with also inflation figures out of the UK, out of Japan, and also the OECD will release their interim economic outlook on Tuesday. So that is always interesting to see how that organisation is thinking and feeling about the future. So plenty to keep an eye on. Enjoy it, team. And the labour market has been exceptionally strong over the last few years, both in the United States and here in New Zealand. But just lately, we've started to see a few cracks appear. So does this mean we're at a turning point? And if so, what does that mean for inflation, interest rates, and the path of the economy? Listen here to find out.